Hey guys, it's Bryan Karp, your boy, aka Mailbox Money, with my co-host Anthony Loffredo on your favorite podcast, the Brick to Brick podcast. And today we have an incredibly special guest, our securities attorney, our syndication attorney, Jordon Cohen. I feel so honored and so lucky that we get to pick your brain and unpack everything to do with syndications and security attorney. But tell us how you, A, decided to become an attorney, and B, how did you go down the niche of being a syndication attorney?
Yes. So I started off as pre-med actually in college, and I made it to OChem and then made my first C ever in my life, and quickly realized being a doctor wasn't for me. So what else was I going to do? I was a government major then, so I proceeded on to law school. And then I started taking tax classes in law school actually because they were multiple choice tests mostly instead of essays. Um, a real great way to pick a career. So I started off doing kind of pure tax work, and then I went to law school at the University of Texas in Austin, and then I moved to Denver to get a master's of tax law after law school. So I did a 1 year master's of tax law. And then in my first job, I was doing a lot of tax work. And then I was also doing a lot of private equity fund work. And so I kind of like the private equity fund work more. And so I kind of veered my career towards the private equity fund and private offering work.
That's awesome. It's funny how you started off medicine and then you pivoted, decided to get everything together to be an attorney. I love it.
Yeah.
Okay, so you said that you ended up taking a bunch of accounting classes and getting your master's in accounting, and then you went to work with private equity. How did you end up where you are today? And for all of our listeners, Jordon and his firm are our syndication attorneys. They've written our PPMs, they've written our subscriptions, they've been incredible advisors on everything we need. How did you end up where you are today?
Yes. So, one of my biggest clients is a private equity firm in New York, and they do all kind of multifamily investing. So they started off doing value add acquisitions. So they would acquire, existing multifamily complexes kind of in secondary markets. And they, make some cosmetic upgrades, increase the rents, and then they flip the properties in 5 to 7 years. I've been working with them for 12 years. And through them, we've been introduced to a lot of other real estate investors like yourselves. And, it's kind of just been a word of mouth type of growth where we work with their investors, and then we have some accounting firms that we work closely with, that will send us clients that are looking to kind of start their real estate investment business.
Terrific. So, Jordon, sort of for a lot of the listeners out there are just entering or thinking about entering the private equity multifamily space. So, kind of just diving right in, what do you think would be, the best advice for them to kind of structure, getting started, and how the funds would get structured from the beginning?
My advice is typically to start small and maybe not try to do a full blown investment fund until you've had a few acquisitions under your belt and you can kind of have a proven track record that you can present to investors. So typically, I would recommend that you start off, kind of forming a separate or limited partnership to acquire each investment. And, you raise money for one deal, one acquisition, and, that entity owns one investment. And then when you're ready to do the next investment, you form a new LLC, and you raise money from a new set of investors. And then once you've, established yourself and you have, some concrete results that you can show investors. You can then move on to the fund space where typically with the fund, you get a capital commitment from a set of investors. So, an investor would say, I agree to, contribute, whatever the amount is, $250,000 to you, and you can call it at any time over the next 5 years. And so then, you have a pool of capital there available to you. And as you decide to make an acquisition, you don't have to fundraise separately for each acquisition. You have the fundraising part done, and you just make a capital call to your investors. So it it definitely streamlines the process. Once you have enough history to start that fund, and you have enough investors to trust you to make those capital commitments to your fund.
Right. No, and that's definitely good advice, especially starting off. Everybody wants to try to be as economical as possible, when getting started. So a lot of times, just thinking of it from from the new investor standpoint, right? So now, okay, we do this partnership, right? We then go out to the limited partners, right? Now the limited partners are going to start having some questions to us. They're going to say, well, how is our money secured? What do we need to provide in order to be, do we have to be accredited? Is it non-accredited? So when you're first starting off in the structure that you mentioned, what kind of answers should the potential sponsors have for their potential limited investors?
So I would say starting off, you're definitely going to want to target accredited investors. So accredited investors is a defined term by the Securities and Exchange Commission. And for individuals, there's a couple of different ways you can meet the definition. So for an individual, if you have $200,000 of income and you've had that for the past 2 years, and you expect to have that in the current year, then you qualify as an accredited investor. Or you can have $300,000 of income with your spouse for the past 2 years and expect to have that same income level in the current year, and you would be an accredited investor. And then you can also meet it if you have a $1 million net worth exclusive of your personal residence. So those are the main ways that individual investors can meet it. There's also, if you have certain securities licenses, you can meet it. But for the general population, kind of those financial metrics are the easiest way to become an accredited investor. And the reason you want to target accredited investors is the SEC doesn't require that you make the same disclosures to an accredited investor that you had to make to non-accredited investors. So if you want to have non-accredited investors in your entity, or later on your fund, you have to go through a much more detailed disclosure process that is almost more similar to doing a full-blown registered offering with the SEC, which is not cost effective, typically for a one-off real estate deal or even a real estate fund. So that's typically why you would target accredited investors only.
This amazing content is brought to you by Future Gen REI. Future Gen REI is a local syndication organization with Anthony Loffredo and Bryan Karp as the syndicators, with over 20 years of multifamily experience. We purchase B and C class assets in secondary and tertiary markets in Tennessee. If you're interested in investing, please reach out to us. We're super, super excited to help you build future wealth with Future Gen REI. Jordon, isn't there, I don't want to use the word loophole, but isn't there some subset of our fund or other funds that could allow non-credited investors?
Yes. So there are two main types of private offerings, and they're based on the exemptions under the Securities Act that allow these offerings without a full registration with the SEC. So the main one that is used is called a 506B offering. And in a 506B offering, you can have an unlimited number of accredited investors, and you can have up to 35 non-accredited investors. So with the 506B offering, you can, have a non-accredited investor acquire, an interest in your entity. But like I said, you have to make much more detailed disclosures to those investors. Um, while it's permitted, there is more of a compliance component if you decide to have non-accredited investors in your investment entity.
Okay. I feel like then I've also heard there's a 506C. What's the difference between the two? And then, it's something I've always been thinking of. I have a huge social media following, and does the C allow us to promote on social media? And I guess talk to us about the difference between the two.
Yes. So in a 506B offering, you are not allowed to do a general solicitation or general sales. So that means you can't advertise your offering on social media or traditional media to try to, get an introduction to investors. You have to rely on your personal network. And the way the SEC defines it is you have to have a pre-existing business relationship with
That's
the
the word.
investor.
That's the word.
And-
Pre-existing. Yeah, that's the word.
And so, the exact extent of that relationship is, not clearly defined, but they do want you to have some pre-existing relationship with your investor. And then, as part of the 506B offering, you can accept a self-certification from each investor that they are an accredited investor. You do not have a duty to take additional steps to verify that, as long as you don't have reason to know that their certification is wrong. In a 506C offering, you can use social media and other methods to advertise your offering. But in a 506C offering, all of your investors must be accredited. So you can't have any non-accredited investors. And you have to take reasonable steps to verify that each investor is an accredited investor. And so typically you would, unless you want to do it yourselves, which, most sponsors do not, you would hire a third-party verification company who would then collect all of the information from each investor that they need to verify that, they either meet that income test or the net worth test. The other way to do it is you can get a letter from the investor's attorney or CPA that says that professional has reviewed the client's records and that they certify that the investor is a accredited investor. But from my perspective, a lot of attorneys and CPAs don't want to take on that risk of kind of making that certification for their client. So typically, the third party verification service is how you go about it.
Okay, so now if we have one and it's a 506B, and then we want to start doing a 506C, is it like just for one project that we could do a 506C for, or do we have to change the entire structure of the overall entity, like on the flow chart? So like we currently are 506B for our 3 existing properties. However, if we wanted to do a 4th one and we wanted to go out and just raise capital on social media for the 4th project, does it have to specifically state the project itself, or can we just say now that we're raising capital for projects going forward?
So it's an offering by offering analysis.
Okay. So
for
it's a deal
you
by
guys,
deal.
each one of your offering, entities or properties has been a separate offering because the issuer of the securities is a different entity. So for essentially each, investment right now that you're acquiring, each new investment entity that you're setting up, that's a separate offering. So for each offering, you can decide whether it's going to be 506B or a 506C offering. And the SEC will allow you to start as a 506B and then convert, to a 506C, as long as you take the steps to verify, that each investor is an accredited investor when you make that switch. They will not allow you to start as a 506C and then convert to a 506B. And that has to do with the general solicitation and sales rules.
And Jordan, when you say general solicitation, so for example, if we were doing a 506B, I couldn't go in front of a large audience and speak about what I was doing, trying to potentially raise capital, correct? But a 506C, I would be able to go in front of masses and speak about it. Is that accurate?
Yes, that's accurate. And, with the B, it is, there's always nuances to it. So if you are part of a business investment group and you meet with them regularly and, you have regularly scheduled meetings, you would be able to get up at that meeting and talk about your offering because you have a pre-existing relationship with them. What you wouldn't be able to do is, rent a room at a convention center and, um, send out a broad solicitation to people that you've never met and then try to sell them on your offering.
All right. So it sounds like it sounds like, Jordan, that, let's just say hypothetically for our next deal, our fourth deal that we would be purchasing, that we could kind of go out, do the solicitation, do all of the stuff on social media, and then when the investors come in, we just hire this third party company to verify that they're accredited. Is that really like the major thing there?
Yes, that's correct. And the third party company may have their, there will obviously be hoops to jump through with them. They may want to, do some money laundering and know your client diligence as well. But they'll tell you what their requirements are, at the time you engage them. But they'll take on the responsibility for doing the verification.
Okay, so that's really the added cost from going from a B to a C, is really that third party company. But everything else from a corporate attorney, like from you guys' standpoint, is really pretty much the same as if we would be moving forward with the B.
Yes, typically the governing document for the investment entity, the LLC agreement or partnership agreement, that is not really impacted by whether you do a 506B or a 506C offering. Your subscription agreement may be slightly different, but for the most part, your subscription agreement would be the same as well. So
yeah, that was going to be my next question, because I know on our existing subscription agreements we have a really long questionnaire for all of the limited partners at the end. So is that all going to be the case, or is that kind of like, instead of that questionnaire, now they have to go through the hoops of the third party that's verifying them?
This amazing content is brought to you by FutureGen REI. FutureGen REI is a local syndication organization with Anthony Loffredo and Bryan Karp as the syndicators, with over 20 years of multifamily experience. We purchase B and C class assets in secondary and tertiary markets in Tennessee. If you're interested in investing, please reach out to us. We're super, super excited to help you build future wealth with FutureGen REI.
yeah, so the questionnaire on the subscription agreement is it's an investor questionnaire where you gather background information on the investor, and that is to bolster your reasonable belief that they are an accredited investor on top of their self-certification. So when you're doing a 506C offering, you're getting a real verification of that. So the need for the investor questionnaire is less because, someone is taking the steps to actually verify that they're an accredited investor.
Okay. And is it a lot for let's just say, I fit the terms, or I fit the qualifications as an accredited investor, although I've never officially had myself accredited. So, but I want to invest in the fund. Is it going to be a lot of hoops for me to jump through, or, because we want to be really disclose everything and as much information as possible to the limited partners, And when they're going to have the questions, what do I have to do? What are they going to ask? That kind of thing. Is it like
Yeah.
is it
The easiest way to verify it is to give your past 2 years tax returns. That will show your gross income. You could try to redact out your social security number if you didn't want the verification company to have that. But your prior 2 years of tax returns plus pay stubs for your current year, kind of showing that you're on track to hit that income level for the current year, that should be sufficient for the third party verification company to be comfortable that you're an accredited investor.
okay? And another question, and I apologize, but regarding the investors on the C now, right? If we already had a pre-existing relationship with them, and now we're soliciting out the terms of the fund, and then at a dinner party we're mentioning the same fund, and they want to invest, but they're not accredited. Are they no longer now able to invest in that project because we went out and solicited it, even though they weren't a part of that solicitation?
Good question.
Yes. So once you're a 506c offering and you do a general solicitation, you can't bifurcate the offering as 506c for certain investors and 506b for other investors. So once you're in a 506c offering, it's a 506c offering for all of your investors, and you would have to take the steps to verify every investor, even if you had a pre-existing relationship with an investor.
Now, Jordon, is there another one? Because I see big syndicators that are on TV and big social media, and they have offerings that are obviously 506c because all they do is talk about it. But I know they said I could take non-credited investors. Is there another solicitation that I'm unaware of?
There may be, I 506b and 506c are the ones that I typically work with.
But what if someone's
those
not
big
accredited?
companies, they may even be doing more of a registered offering where they've taken the steps to do an SEC registration, and that allows them to sell securities, to a wider pool of investors. So my guy is telling me that they're probably not doing a private offering, that it may be a registered offering with the SEC.
I got you. Okay, so the 506b and the 506c are private offerings.
Right. There is no pre-registration with the SEC. And then typically with the 506b or a 506c offering, the only thing you need to do with the SEC is it's called a Form D, and you file that after you raise the money. Not every sponsor decides to do the Form D. It's a safe harbor with the SEC, so it means that you're more likely to be safe. That's the safe harbor. But not filing Form D does not necessarily mean that that you lose the exemption for your offering. You're just not within the safe harbor.
Okay. How does it work we're getting a lot of people because we're having so much growth. And even though we're relatively new to the syndication world, 2 years young in that world, we've been real estate investors for 2 decades. We're starting to get a lot of people reaching out to us that want to introduce us to friends and colleagues and other individuals. How does the SEC look upon that? And how does that kind of all play into this?
This is where, like I said, the friends of friends, the rules are not entirely clear. And then, full disclosure, I am not a securities law expert. I'm kind of, I do the fund work and I'll do a private offering, but some of the nuances of the securities laws, you'd want to talk to an attorney that really specializes just in SEC compliance. But
I always tell everyone this is for information. This is just for informational purposes only. We're just 2 guys in New York chopping it up with our friend Jordon. So don't if you need specialty advice and you need something, you need to reach out to a professional on that end that is registered.
Yes. So the friend of a friend, my understanding is that, once you've had that introduction, it probably the meeting that you were introduced to them, that you would not have that pre-existing relationship to solicit them to invest in your fund at that point. But once you've met them and say you do another investment where you invest together, maybe not in something you sponsor, but something that a third party sponsors, or you, like I said, you're in an investment group or something where you're meeting friends of friends. I think at some point you would have that pre-existing relationship and you could solicit them. That line of exactly, from that first introduction to 6 months down the line of how much interaction you need to have in that interim. I don't think that's clearly defined. So it is a little bit of a gray area on how much of a relationship you need to have.
Well, it seems like you can just cover your bases by if you're gonna take that relationship to really be a 506c, where it could be more promoted, I guess.
Yeah.
On that end.
All right. Jordon, another thing that we talk a lot about with our limited partners is the depreciation aspect of how the funds are structured, and how much of the depreciation benefit that the limited partners are going to get in comparison to the general partners, whether or not the limited partners are going to be able to use it. So if we could talk just a little bit about that and kind of what you see as the norm or the benchmark for how these funds are set up as far as the depreciation benefits for both the sponsors, the general partners and the limited partners.
Yes. So this is, there's some tax concepts involved here. So, typically the sponsor of the deal is going to want to take a higher percentage of the depreciation than they would be entitled to just based on their, straight percentage ownership, or, the percentage of capital that they contributed to the deal. So you can specially allocate, in the case of an LLC, you can allocate a higher percentage of the depreciation to a sponsor. But that means, obviously, that your LP investors are getting a lesser percentage of the depreciation. For the sponsor to be able to take that depreciation, there are, a few hurdles you have to meet first under the tax code. And there's, kind of three different sets. There's the at-risk rules, there's the basis limitation, and then there's a passive loss rules. So all of those you have to meet to be able to actually claim the depreciation deductions. So I think, the details of those rules are probably outside the discussion today. But it's just to say that even if you do get that special allocation of depreciation as a sponsor, it doesn't necessarily mean that you'll be able to benefit from that depreciation. But typically, because the sponsors are guaranteeing the debt on an acquisition, that does free up their ability to claim that depreciation.
Yeah, that we know is a big topic that we talk about a lot with our limited partners, and of course, obviously it's a discussion to have as with the accountants as well. So I just know that's something that us and the accountants kind of all go back and forth with, so that we're all on the same page. So that when we're talking to our limited partners, everything kind of fits in exactly what we have from the structure and the actual forms and everything.
If you guys like this content, I'm going to ask you to like, subscribe, and share. This is how we grow the channel, and all of our podcasts are sponsored by Future Gen REI. Future Gen REI is a Long Island-based syndication, which is Anthony and myself. And what we do is we purchase multifamily property in Tennessee in secondary and tertiary markets. Jordon, I feel like you and Anthony are CPAs, and we dove right into like the amazing, super complicated stuff. Could you just break down quickly for our listeners the different documents in a syndication, what a PPM is, what a subscription is? And then I see this thing that you're always sending, Anthony, which is, I guess, our LLC, our operating agreement for our LLC.
Yeah.
I feel like that's like elementary. Could you just break that down for everyone?
Yes. So, and we'll start. So, the very first thing when you're ready to set up your investment entity, typically most sponsors will form them in Delaware. Just for the same reason that all the big corporations are formed in Delaware, it's a stable set of law. They have a special set of courts that just decide business disputes. And so, a lot of sponsors will form their investment entities in Delaware. So the first step is filing a certificate with the Delaware Secretary of State, and that actually forms your LLC. And then once your LLC is formed, you would work on the LLC agreement, or it's called an operating agreement in other states. So your LLC agreement is going to govern kind of the operations of the LLC and the management decision making. And it's also going to detail the economic arrangement between the members of the LLC. So with an LLC, it's really all a contractual based entity. So you have great freedom in your LLC agreement to set up your economics and your management structure based on what the parties agree on. And the actual statutes in Delaware give you the freedom to do that, and they don't really impose any mandatory rules on you. So in other words, if and in the typical real estate investment, the sponsor is given, broad control over all decisions of the LLC. So whether to, sell a property, get a loan on a property, remodel a property, all of those decisions would kind of be held by the sponsor. And the limited partners would have limited to no voting rights in the management of the LLC. And that's not to say that every investment entity has to be set up that way. Like I said, it's all a negotiation between the sponsor and their investors. So on top of management, the LLC agreement will detail the economic deal between the partners. So typically in a real estate investment, the economics are going to be an investor, makes a capital contribution, puts cash into the entity, and they are entitled to a return of that capital plus a certain percentage of a stated percentage return on that capital, almost like an interest on a loan. So typically it would be in a 6 to an 8% return. So all cash coming that the LLC has available to distribute. So that would be your rental income after you pay essentially your debt and all of your other operational expenses. So whatever cash is available to distribute at the end of that would go to the investors until they've received their capital back, plus that 6 to 8% return, or higher depending on the deal.
And that's what the LLC agreement states.
Yes. So the LLC agreement will detail those economic terms and the management terms. And then typically the LLC agreement will also contain transfer restrictions. So because you're doing 506B or 506C offerings, the investors cannot, once the investor has invested, they really are, almost stuck in the investment until it's liquidated. Their ability to sell that investment to another investor is it's very limited and really almost non-existent. And so, once you make an investment in a private offering, you're in the investment until it's sold and liquidated. So typically the LLC agreement will restrict all transfers of interest in the investment entity as well. So those are kind of the three things it deals with: is management, economics, and transfers.
Okay, now what does the PPM and the subscription do? I thought that they did those things.
So the subscription agreement is where the investor will say, I agree to invest X dollars into your entity in exchange for an equity interest in your entity. Typically, sponsors, to limit the number of investors, you'll set a minimum investment for your entity, whether it be 100,000 or 200,000 or or higher. So, and then the investor can decide to invest any amount above that minimum threshold. So the subscription agreement, the investor would sign it, and that's where they bind themselves to make their investment into your investment entity. And they also make representations and warranties about their status as an accredited investor and certain other things for securities law purposes.
All right, all right, all right. I'm becoming dangerous now. You're giving me too much information. Okay, and now the PPM, where does that fall? What does that do now?
Yes. So the PPM is not a required document. It, I've in more recent times been kind of combining the PPM with the subscription agreement, but the PPM is short for private placement memorandum, and that typically is an informational document that you give to investors, and it would describe the investment, so the physical property that your new entity is going to invest in. It may give some financial modeling of what you expect the cash flow from the investment to be and the returns to the investors. And then it usually includes a list of risk factors that the investors should be aware of before making their investment. And the list of risk factors is usually very broad, and it makes it almost seem like the sky is falling. But that is really to protect the sponsors, because if the risk factors is essentially disclosures to your investors. So if you put something in the risk factors, the investors, then have knowledge of it, and they can't come back and claim, that you never told them or they weren't aware of that risk, or if they had known that risk, they wouldn't have invested. So the risk factors is really there to protect the sponsor, from an unhappy investor.
Awesome, Jordon. Anthony would take your entire day and keep shooting questions at you. But I want to be mindful of your time, and I just really want to thank you so much. Can you give us the contact information for yourself and your firm? So if anyone is interested in setting up a consultation with you guys, or anyone's interested in moving forward with your guys in this capacity, how could they find you guys? What's the best way to get in touch with you?
Yes. So our firm again is Bellborn, Sullivan, Meck and Tooley, and we're located in Denver, Colorado. And the best way to get in touch would be